What's up, everybody? What you're about to hear is a live Q&A call that I hosted on Wednesday, December 13th, with Rory Johnston of Commodity Context for members of our Hidden Forces Genius community. He joined us to talk about the oil market, including refined products amid the large downward move in oil prices that we've seen since the end of September. We discuss investor positioning, what's going on with U.S. production, some of the recent M&A deals, OPEC production cuts, geopolitical risk in Guyana, as well as in the Strait of Hormuz, and much more. If you're interested in learning more about the Genius community, our private dinners, in-person events, and how to become a member, you can do that at hiddenforces.io/subscribe. And with that, please enjoy this timely community call with energy analyst, researcher, and founder of Commodity Context, Rory Johnston. What's up, everybody? Welcome to today's call. Same rules as always. If you have a question that you want to ask, raise your hand or put it in the Q&A box. And please use the comment section for any comments you want to share. For new members, Rory usually comes on every couple of months. And as usual, we'll be posting the video from this call to our events replay section. So if you have any additional questions that you didn't have a chance to ask him during the call, feel free to post them in the video comment section, and Rory will respond directly to you. Also, a reminder, if you're interested in delving deeper into the subjects that Rory and I talk about today, there is a special price for Genius members who want access to Rory's research. So feel free to DM him in Circle, and he will get right back to you. So, Rory, it's great to see you, man. How you doing?
Thanks for having me back, Demetri.
So you where's the last? Yes, you were on last time just when we had gotten back from Greece. I think we had just gotten back from Greece.
Yep.
And I was just saying that in that call, I told you, the oil bulls are back. The oil barrel emojis are back. And since that call, the price of Brent has dropped something like 25%. I think $23. And so what happened? Catch us up a little bit on what's happened since you were last on the call, what the narrative was at the time, and what investors are focused on now.
Yeah. So I think the first thing that I want to get out of the way is the role that speculation has played both in the drive up and the fall back down. Because I think looking at the price, you would think that everything had fundamentally changed. Basically from the high point where we hit about $97 a barrel Brent at the end of September. And we're currently sitting at around $74 a barrel Brent today on the screen. So obviously we've come down about 25%. But the important thing here is that while the market has absolutely deteriorated, between late September and today, no doubt about it, all the signs have shown kind of weakening of the market. I think if you're looking at just the price, it's overstated, one, how tight we got in September and how bad things are right now. So just to put in perspective, the main data I look at for judging what I consider kind of speculative positions in these contracts is the commitments to traders data that's published by the CFTC in the States and the Intercontinental Exchange in Europe, home of Brent. That data shows that the managed money component or speculative positions in these contracts hit a 2-year high in late September, helped push those prices up. So we were fundamentally tightening. There was tightness in the market at that point, but that was supercharged and probably added, it's always hard to tell exactly how much it's adding, but probably in the ballpark of at least $5+ a barrel. And similarly, we went from that really, really overextended position in late September, and we've plummeted right back down to where we are today. And spec positioning today is at its lowest level since the initial route in 2020. So obviously, we've had this big kind of move, but if your mental model is going off of, we've had a $20+ change in the price of oil, which is a huge deal, I think the first step is to kind of just take a step back and say, it probably isn't actually a $20 organic move. It's probably more like 10, that we were, let's say, as a ballpark, $5 overvalued in September, and probably in the ballpark of $5 undervalued today. The theory here is that you don't typically keep these positions forever. If you look at the kind of net position of these speculators, it tends to mean revert over time. And when mean reversion in this case typically means either selling long positions if you're really overextended long, which puts downward pressure on the price, Or in the case right now, you either have very few long positions that you need to rebuy to reaccumulate those positions, or in this case, more likely, you've accumulated a large gross short position. And in that case, you need to cover those shorts to get back out of that position. So that will put upward price. So I would say that, before we get into everything else, that I think is the important thing to understand is we've probably had a $10, maybe $15 a barrel kind of reduction in the price on a fundamentally justified basis. But beyond that, everything else has been this kind of speculative chop. And we've seen Bloomberg actually had a really good article, I want to say 3 weeks ago now, about the rising prominence of what they call commodity technical traders, technical advisors. And that is, this kind of rise of speculative money in these things, bot trading, et cetera. And the main conclusion there was like, all this really does, the main result is it accentuates and accelerates pre-existing moves in the market, which again, explains the fact that we got overextended when we finally got bullish in September. And now we're in the absolute dregs again. So, let's say right now we're at 74. We're probably more like high 70s, low 80s on a kind of a positioning adjusted basis. But even then, that is still obviously well down from the 90s we saw in September. And I think that's where we get into what the heck's been happening in the market, these, this latest OPEC meeting, et cetera.
Right. So let's get into those fundamentals, because we're in a situation now where both demand has been strong and continues to surprise to the upside. And at the same time, we've had a series of negotiated cuts by OPEC, including the recent announcement of a voluntary cut of over 2 million barrels per day in the first quarter of 2024. So what is going on here? How is it that prices have dropped when demand's been so high and OPEC has been cutting production? And what can you tell us about what's come out of the recent OPEC meeting, as well as Saudi Energy Minister Abdulaziz bin Salman's recent comments to Bloomberg about continued production cuts?
Yeah, so just to start with the first comment around demand, I think one of the bizarre things about this year is when people were debating last year, it was essentially a question of how strong will demand growth be? And bulls were like, we're going to get a huge demand year, 1.5, 2+ million barrels a day growth. China's going to bounce back, et cetera. And the bears were like, no way, we're not, we're going to see further economic weakness. You're not going to see that big a jump from China, et cetera. And that was essentially the core of the debate. The irony is that we've actually had a pretty crappy year for crude prices. We haven't really seen, we haven't seen triple digit barrel at all. But we actually had really good demand growth. No. So the both sides were right, but for the wrong reasons. And I think, so the one thing I will say about demand is this year has been very, very China heavy. By far the dominant kind of impulse of demand growth in China. Europe and a lot of the rest of the world have been quite weak. So like that side has been really relatively bearish. But on an aggregate global basis, demand's been strong. The rub here, and what even the bears weren't really focusing on last year, is just how strong, particularly U.S. supply growth has been, and broad non-OPEC. So outside of the United States, you've seen kind of continued, strong growth from Guyana and Brazil, et cetera. But in the United States, the growth has been bananas again. Like it feels like pre-2020, heyday of shale. On a total liquids basis, U.S. growth this year is trending around 1.5 million barrels a day, which is a lot of oil. And that's like almost the level of global demand growth, which is, again, if the U.S. can grow alone can grow alone by that volume, it forces OPEC to kind of contract its share of the market, which is exactly what we've seen. So that's been the thing that has really stymied the bullish argument this year and generally was very unexpected. And by generally unexpected, I mean also by OPEC and the Saudis. And I think the important thing here is this latest meeting we had, where it was a delayed meeting. There was obviously a huge amount of kind of drama around the proceedings. It was supposed to take place in person in Vienna. Then there was a delay. Then it happened online with no press conference afterwards. It was a bunch of weird kind of clearly kind of political, crisis issues going on. But that was when they agreed to what they pronounced as a 2.2 million barrel a day headline cut that would take effect, at the beginning of the new year. That's their fourth real cut in just over a year, which is a lot of cutting. You saw the cut in October at the end of 2022, which was what I called a paper cut at the time because it was mostly absorbed by quota under compliance. Then you saw what was the real first cut, which is the voluntary cut in April of earlier this year. Then you saw and that was a voluntary cut, which you actually did see decent compliance with. And then you saw the Saudis and the Russians commit to unilateral cuts at the July meeting. And then finally, now you've seen those cuts extended and additional voluntary cuts made for the start of this year. But the first thing I'll say is the 2.2 million barrel a day cut, which again is what the Saudis are pushing. It's what OPEC announced, et cetera, et cetera. That really isn't a 2.2 million barrel a day cut because the market had really already baked in an extension of the Saudi and Russian unilateral cuts, which alone were worth 1.3. So at best, you're probably talking about maybe 900,000 barrels a day of additional incremental cuts. And on top of that, 200 of those were Russia and its weird export thing, which we'll talk a little bit in a second. But I would say broadly, it's really only a 700,000 barrel a day cut, which is still a decent sized cut, but it's not 2.2 million. And I think if the pre-chatter going into the meeting was that the Saudis were going to get another real 1 million barrels a day of cuts, then that was a reasonable underperformance. The final thing here is I really think that, when OPEC Plus agreed to those voluntary cuts, and particularly when Saudi Arabia agreed to those unilateral cuts, they did not in any world see them going on this long. OPEC itself expected the market to tighten considerably, well more than what we saw. When the Saudi unilateral cut was initially announced, it was announced on like a month-by-month basis. There was no end date really communicated. It was like, we'll let you know next month if it's going to keep going. And then it kept going and going and going, and eventually they extended it to the end of the year. But I think that's your sign. Like, they did not expect this thing to be going on for a long time. And if you look at the history of Saudi Arabia, they have many reasons and like good historical precedent to not overextend themselves unilaterally for such a long period of time. And I think part of this latest OPEC meeting and the drive from Riyadh to try and get other OPEC members to contribute more, if anything, should be seen as obviously additional support to the market, but specifically kind of broadening and trying to bring others in to burden share what Saudi was already doing. I think it's very important in Riyadh to be seen as not doing everything yourself. You need to kind of burden share. And I think that's a lot of what we saw. And the challenge too is like when you look earlier this year, or even late last year, a lot of people were talking about how OPEC broadly and Saudi specifically thought and felt that they had a lot of maneuvering room and a lot of latitude with these cuts because they didn't expect the US shale patch to reaccelerate in any meaningful way. And obviously that is the single greatest thing that is spoiled. I mean, there's a lot of there's, Iran has, we talked about this last time. Iran has been producing more and a lot of these other countries have been producing more, but nothing even holds a candle to what we've seen in the United States. And Iran, at least theoretically, they're working back towards some kind of capacity level that is estimated. Whereas the United States, it's like, it's just new oil, and a lot of it at that.
When was the last time we've seen U.S. production grow this much?
It has been really strong through the pandemic, but that's because you were coming off such a depressed base. Obviously, production fell considerably through the initial COVID period, so you saw strong growth coming out of that, but people just expected it to kind of peter out. This whole stuff about cash flow discipline and not overgrowing, et cetera, et cetera.
So is that the main reason? That was my next question. Why was it so unexpected? Is it because the Saudis and investors bought into this narrative that investors would want to see more cash back before they started to plow it back into future production capacity? Or was there something else, just a belief that there wasn't as much oil available at these prices?
Yeah, I think a little bit of both. Mostly, though, the former. I think mostly this idea that the U.S. shale promised they wouldn't grow this fast. Why would they lie to us?
So just to clarify for listeners, this is the narrative that you're talking about that emerged during the pandemic, that investors had lost so much money after the collapse in oil prices in 2014 that they were in no rush to invest in future capacity and much more focused on dividends and recouping some of that lost capital as income from the underlying businesses,
right?
Right? That's the narrative that we're talking about here?
And just put a number on that, ballpark, you're looking at like in the decade prior to COVID, the US shale patch overspent by about $500 billion. That's how much capital was essentially destroyed by the industry during that period. And that is obviously a huge chunk of money. So the hope here was that they were finally just going to kick back and collect free cash flow in what was supposed to be a high price environment. And now both sides, they have been investing more and prices have come down. And obviously they've come down because they've been investing more.
What's the theory as to why that happened?
So there's a couple theories. If you look at the bulls today, because I think it's valuable to look at, where people that were arguing something would happen, what did they say went wrong? And the dominant kind of narrative today is that you've seen a lot of these private producers, those that aren't answerable to investors in the same way in the public market, that they had been growing very aggressively in order to basically juice up their numbers, in order to sell themselves to other producers. And, I think we'll talk a little bit about M&A down the road, but I think everyone is now looking like, now these valuations are getting juicier. Maybe we can sell ourselves to an independent or one of the majors or whatever. And they're trying to get better numbers to do that. But I think there's two challenges with that as the dominant thesis. One, if you go back to some of our very, very first conversations, Demetri, back even before the community, I think even when it was just the podcast, we were talking about the barbelling of US production growth between privates growing fastest, a public independents growing slowest, and public majors growing kind of a medium amount. That same phenomenon has persisted to today. And what you've actually seen is privates over the last couple of months have actually stopped growing as quickly. So there is obviously challenges to that thesis. And I think that, again, the thing that kind of proves true time and time again is that US shale and oil companies like E&Ps broadly, they want to grow. As long as they can grow, they're going to grow. And I think we're going to go through cycles here of, we're going to believe the management teams. We're not going to believe the management teams. And I think at this stage, I think there's obviously a lot of doubt right now as to if, that's going to happen. And I think even when you're seeing, like, the other notable thing is like those slower growing independents, people like arguably, Pioneer that was acquired, they were the ones that were growing slowest. And, obviously, Sheffield, the CEO of Pioneer, said, like, I don't care if it's $200, $300 a barrel, I'm not going to grow production capacity. But they sold to Exxon, who's one of the fastest growing, in the patch, because the majors are growing more quickly. So I think those assets also could theoretically grow more quickly under major management than under independent management.
Which
again, I think is a change here. And once again, like this year, if you look forward to the forecast for next year, everyone once again expects US production growth to more than halve, from like 1.5 million barrels a day by latest estimates for this year to something more like 600,000, maybe 500 to 700,000 barrels a day next year. That obviously would considerably help tighten up the market. But given the number of times people have been wrong to the downside of US production growth, I think at this stage, our bias needs to be that they will likely probably outperform that. The question is how much. And I think that's the billion-dollar kind of oil market question, is where is shale actually going to add next year?
So I have a follow-up question on M&A activity, but since you brought it up, what's the reason that they expect investment in U.S. production to have? Or what was it you said, the investment to have or output to have?
Growth to have. And I think, there's expectations that, prices are lower than, we had expected, obviously, as we're seeing right now. I think there's an expectation that more dour pricing environment will continue. I think a lot of what we've seen this year has come from productivity gains. I mean, the weird thing is when you look at the rig count, which is one of the most popular metrics for assessing oil field activity, it's declined for much of the year, and it peaked at the end of last year. I think that's, it's jostled around since. But looking at the rig count alone, you wouldn't be like, aha, yes, growth is strong again. And I think this, so the argument is that, unless we get more rigs in the field, unless we get higher prices, that inevitably we can't continue to increase productivity like we saw this year. And I think, again, that's a bet we've made before. And generally, historically, we've been often wrong about it. So we're going to see whether or not it comes to the fore again.
So you mentioned Exxon Pioneer. That deal's been done, right? It's concluded. Exxon purchased
I believe
Pioneer?
so. I should note that I don't focus explicitly on any of the equities, but I think it's been announced as a done deal.
So I know Chevron and Hess is another one. I don't think that's done yet. I don't know if the Occidental Crown Rock is done yet. But one of the theories I heard is that part of what explains the extra production above expectations is that a lot of companies are trying to shore up their balance sheets and look pretty ahead of potential acquisitions. What kind of merit do you put in that story?
Well, so the funny thing there is it's kind of what I was talking about earlier. And the main area where you're seeing that play out was on the private side, whereas obviously Pioneer, Hess, et cetera, they're not private. They were actually part of that theoretically slower growing US independent core. So it's actually the opposite for those participants. You've actually seen lower production. With Hess in particular, obviously, you've had the added bonus of its Guyanese exposure. which I think everyone acknowledges was one of, that was the crown jewel that Chevron was really after, was to try and tap in. Again, I mean, no matter which way you look at it, the Guyanese production growth, it's like staggering, historic in terms of just how successful that exploration has been. And I think people are still very optimistic, even in light of what we've seen more recently with the kind of machismo move from Maduro to kind of, hold this referendum and trying to, threaten the territorial integrity of Guyana.
There's more to talk about. Yeah, that's on my list too. I have one other question. So when we were talking about OPEC, so when was it that OPEC reversed its cuts the last really big time that we had a cycle like this, which was in the 1980s? Was it 1985 that they gave up on trying to control price?
Yeah, I mean, I often go back to, if we're thinking about, one of the, I think the big worries for this year and at any point going forward now is that OPEC is withholding so much oil and we're sitting at $75 on Brent. It's not super bullish. How long do they keep this up? How long do they continue effectively subsidizing U.S. shale if U.S. shale does continue to grow? Because again, remember, part of the thesis, for last year when this was all starting up again, was that they could cut and they could juice prices, and even with higher prices, U.S. shale wasn't going to grow. That proved faulty. So the question is, now they're just trying to hold onto the market, and how much longer are they going to be able to do that? That remains the big question. So when you look back in time, at in the 1980s, I've written a lot about this, that when you look at the reason that Saudi Arabia does not want to be a unilateral swing producer is because the last time they did it in the 1980s, it was the last time they really cut that aggressively and that, solo. At one point in 1985, the summer of 1985, Saudi Arabia was producing less oil than the British portion of the North Sea. And the North Sea at this stage would have been the shale of the mid-1980s. It was kind of birthed by the price booms in the 70s and early 80s. And that's where the main growth center was. And at that stage, the Saudis were like, we're going to cut and try and, allow this supply to come in without being super disruptive to the price. And we're just going to do all it ourselves. By the time that they were deeply embarrassed of the fact that they were producing less than the British, because let's get real, the Saudi Arabia should never be producing less oil than the UK. The king basically said, open the taps. And that happened through, the crash really happened in 1986 and lasted the better part of a decade. You basically had this lost decade of oil prices until you really started to get the reacceleration in the 90s and then obviously into the 2000s. But, you had this lost decade that was prompted very much by this releasing production and trying to more or less drown the competition out of the market. The worst case scenario for oil bulls today and the worst case scenario for oil prices is that we see a repeat, that, Saudi and everyone else says, screw it. Let's see how resilient U.S. shale really is.
But they tried that recently and it didn't really work.
Well, in 2014, that was the theory there, was that they were going to essentially engage in a market share war. That stage, U.S. shale was still very immature and had never really faced a down cycle. At that stage, I remember writing papers when I was at Scotiabank being like, oh, well, the estimated break-even cost of U.S. shale is like $90. Well, that turned out to be grievously wrong because the break-evens more or less halved. And what you saw was all of these producers that had gotten so much fat had entered the system that when they finally, it was essentially cut the fat or go out of business, well, all of a sudden you found a huge number of cost savings. A lot of that was pushing back against the service companies, which is why the oilfield service industry got hit so hard through that cycle. Because essentially, if you're a major or whatever, you're like, well, for completion services, we're only going to pay you half this year of what we did last year. And the services are like, well, that's not cool. We were kind of banking on that money. And they're like, well, it's either 50% or nothing. And I think that's where, and the dominant power remained with the E&Ps and not the oilfield service companies. I think the question now is, would U.S. shale be as resilient today? I mean, obviously, I could make a fool of myself by saying anything about the future of shale because, as I just noted, everyone's been wrong for a decade. But I think it's less likely that U.S. shale would be as resilient to the same type of market share war today because they had worked out a bunch of that fat in the system. They had kind of made those cost cuts. I think, in many cases, those were like a one-hit wonder. You've seen inflation in the patch. You've seen all these other things that I think are going to be harder to undo today. So I think it would be more successful. The other thing is OPEC actually has more ammunition today than it did in terms of, if you're thinking about it from market share war, because they have more members. They have, because OPEC Plus didn't exist in 2014. So they have more membership, and they also have more withheld oil production. There's a larger delta between current production and estimates of peak capacity.
How accurate are those estimates? Because there has been some controversy about that, especially the Saudis.
There's always going to be controversy about the Saudi estimate because they've really never produced it at peak capacity. But I would say so far, they've always been able to kind of produce more when push comes to shove. So I would say the benefit of the doubt, I think, remains with Riyadh on their capacity for now. I think actually the bigger one in some ways, obviously Saudi is withholding the most, but one of the more uncomfortable members of OPEC through this entire system has been the United Arab Emirates. And the main reason is that, while everyone else gets deeper cuts in the beginning of the year, UAE is actually going to produce more because their baseline is being revised higher, because right now the delta between their baseline, essentially the number against which the cuts are calculated, is now about 1 million barrels a day lower than their estimated production capacity. And that's because these baselines were decided, and many of them haven't really changed since 2017, when OPEC Plus first really, came to be. And I think that is a huge challenge for the United Arab Emirates, which has been investing a lot of money in expanding that production capacity. So the UAE alone could probably produce upwards of 1 million barrels a day more crude, which again, if the alliance fell apart, I have no doubt that they would pump way more because they have been chafing against this deal and against this baseline for years now.
So you kind of just touched on what was going to be my next question, which had to do with the durability of this alliance. Well, first, on a historical note, when was the period of OPEC irrelevancy? There was some long period after that, the North Sea oil boom, and I guess the mid 2000s. When was it that OPEC really became irrelevant or less relevant?
Well, yeah, OPEC becomes less relevant when the market is looser. And I think it's also the challenge here is that, through that period, OPEC was still withholding a lot of spare capacity in the scheme of things because they didn't want the market to completely collapse. So it's hard to say that OPEC is ever purely irrelevant because they still are such a big force on the supply side. But no doubt that when it came back to, the price spike in 2008 and then the bust in 2009, and then again in the higher price period of kind of 2010 to 2014, there was a lot of focus on OPEC because at that stage people were worried about OPEC running out of spare capacity. And that's, when people last were really talking about things like Saudi spare capacity or those capacity estimates was how much do we really have? And it wasn't that long ago that we were talking about this. In the beginning of 2022, people were writing about how Saudi was overestimating their production capacity and we were literally running on fumes in terms of spare capacity globally. And I think one of the challenges is that we actually didn't stay tight enough in the market to test that theory, because by the time it really, push came to shove, the market weakened considerably and then OPEC went back to cutting. So we were never really able to see how long Saudi Arabia, as an example, was able to sustain over 1 million barrels a day of production of realized production. And their estimate of production is more like 12. So their estimate of capacity is more like 12 million barrels. So it's hard I would say my bias is to say it's attainable, or at least something close to it is attainable, but it's an untested thesis because the market has never been tight enough to force them to produce that level for any extended period of time.
What is the risk to the alliance here? And how important is it that Russia is fighting an ongoing war? Because there's something else I was telling you, that it's always difficult to monitor and prevent cheating in organizations like this. But it seems particularly difficult to do in light of the fact that the Russians have an ongoing conflict in Ukraine and they need money. Also, the Saudis have a lot of commitments that they've made that they need money for.
Are you talking about all the billions that they're promising various athletes around the world?
Thank God they didn't contract with Messi. That would have been another whatever,
Exactly.
It's amazing what these guys are getting paid. It's absolutely mind-blowing, the numbers.
You hear it come up in oil arguments that the fiscal break-even of Saudi Arabia is literally increasing with these sports and athletic commitments, which is just a bananas thing to enter into the conversation.
Yeah, no, it's wild. There's so much inflation in those contracts. I remember when the Lakers signed Shaquille O'Neal back in 1996 and they gave him a 10-year, I think it was a 10-year, $120 million contract. And I remember being blown away at the size of the money. And what these guys are getting paid now is off the charts. We can't even begin to imagine.
It's absolutely wild.
So go back to my question there is like, what are the risks to the alliance? Could you really seeing it sort of, what would happen? It would break apart, not break apart literally, but like become again less relevant? Like what would we look to understand that?
So a couple of things. So I think the first thing to understand, very important from this top, and I think what you've seen is, and we can, well, this will, I think, circle the conversation a little bit, but for anyone that's interested in kind of understanding the Saudi position a little bit more, there was about a 40-minute interview between Abdulaziz bin Salman, the Saudi energy minister, and Bloomberg News, which itself is interesting because Bloomberg News is officially uninvited from all of the OPEC meetings. So I found it interesting that they were the choice.
Why is that? I did
not
know that. What's the backstory there quickly?
Oh, yeah. So Bloomberg, Reuters, and the Wall Street Journal have all been uninvited. They don't get to go to OPEC meetings anymore because they weren't printing particularly flattering stories, and the Saudis accused them of misinformation about the deal. But anyways, I thought it was interesting.
They also had some authors that came on the show. I think I had two different shows that I did on MBS. At least a couple of those two authors, I think, were Bloomberg reporters. So yeah, you're right.
Exactly.
They were hammering. That's correct. You're right. They were hammering Saudi Arabia.
So I think the most important thing to understand is like everything about, and this is something that the Saudi minister stresses in his interview as well, is that OPEC is inherently a voluntary organization. We talk about voluntary or cuts or whatever, but like in truth, they're all voluntary. OPEC has no formal disciplinary mechanisms. You know, like as an example, Iraq has been overproducing its quota, and that was an issue that was discussed at these latest meetings, overproducing by like, let's say 100,000 barrels a day. Not huge, but Iraq has a history of overproducing quotas. It's overproduced quotas literally forever. It was actually funny that for much of the pandemic, it's actually produced at, around or underneath its target. So that's actually new. But let's say, like, how could OPEC or Saudi Arabia specifically punish or discipline Iraq for doing this? And there's really no formal mechanism. The only thing really that the Saudis can do, and by that I mean really OPEC, to punish Iraq in this case would be to boost their own production and basically punish them via prices. Saudi's power and authority within the organization comes from the fact that it's such a large producer and it's so wealthy. It can shoulder a revenue hit. Riyadh can shoulder a revenue hit far better than Baghdad can. And Baghdad knows that the Saudis can move the price a lot more than Iraq can. So when you saw at the beginning of COVID, when initially, rather than cutting production in the face of the initial pandemic demand loss, the Saudis, the Emiratis, the Kuwaitis, and all of that core GCC alliance with OPEC, they all dramatically boosted production because the rest of OPEC Plus, and specifically Russia, was balking at the idea of such a large cut to balance the market. But the only way that the Saudis could get people on board was to just do the exact opposite.
I remember that. I remember that.
Yeah, and that remains true today. That's the only real way they can get anyone to do anything. There's no real other mechanism.
I remember covering that, and I remember not understanding until we covered it how it was that Saudi wanted more cuts, and then their reaction to not getting them was flooding the market.
Yeah. And that's, and what you'll see time and time again, that's really the only mechanism they have, that and threats. So in terms of the future of the alliance, I think there's a couple ways it could go. Sure, OPEC Plus and OPEC could just literally disintegrate. It could disappear. Again, none of it's, forced, none of it's like binding. There's nothing to stop the countries from just doing whatever they want tomorrow, except the fact that there is a historical path dependence and a kind of a generalized kind of developed respect for, let's say, Iraq or the UAE's position within OPEC. So there's a path dependence there that I think holds them together. That obviously is less true for OPEC Plus, which has been around a fraction of the time that OPEC has. And obviously OPEC Plus is not nearly as integrated into OPEC. Like, for instance, today OPEC's monthly oil market report was released, and part of that is that they kind of have this secondary source estimate aggregate of all of the different countries' production numbers, and that estimate is what they use to assess and judge compliance with quotas. It only exists for OPEC. There is no commensurate table for OPEC Plus. Like, the OPEC Plus members don't have the same degree of kind of public tie-in to the rest of the alliance. So I think, you could see that happening. But I think, honestly, this stage, I think what's more likely is not that the alliance formally falls apart, but that understanding of it and the purpose and function of it just changes and evolves over time. I think the latest example you've seen that tilts us towards this likelihood is the fact that in this last OPEC meeting, one of the big announcements that I think no one, including myself, was expecting is that apparently Brazil is joining OPEC Plus. And it's like, wait a second. Why? Like, why would Brazil? Again, if you remember from the beginning, Brazil is one of the fastest growing non-OPEC sources of supply. Why would it ever agree to join an organization that would throttle or control its production? And the answer apparently is there will be no controls on its production. It's joining as essentially a like a frenzy member.
So that's also kind of fits with the Saudi oil minister's comments, energy minister's comments to Bloomberg with respect to Russia, right? Which is kind of like, it almost feels like their policy towards Russia is like, yeah, we want them to cut, but if they don't, it's okay because we don't want to lose them.
Yeah, exactly. And I think what you've seen to some degree is like you've seen the proliferation of a lot of these alternative political bodies, transnational organizations, things like the BRICS, the BRICS organization has become much more of this formal kind of quasi, G10 parallel or whatever, right?
Yeah.
I think in some ways the vision is that OPEC Plus becomes something similar, that it's a bunch of oil producing countries that are like-minded-ish in their disposition, and they feel like it's better to have more people inside the tent than kind of a tight organization. From my perspective as an oil analyst, it's stupid because like they're there in name only. And that when we're talking about OPEC cuts, you're like, well, is Brazil cutting? Well, of course, Brazil's not cutting. I mean, famous last words, but I don't think Brazil would ever agree to cut because, again, why would they? They are still growing. Again, they would run into the same issue that the Emiratis have now, which is if they participated, their baselines would be set now. And that given that these cuts apparently never really actually end, they'll always be cutting based on what will end up being very, very stale production capacity data. Because again, we're expecting Brazil to grow next year, the year after that, and the year after that. So it's just kind of confusing. But I think it speaks to the fact that the Saudis in particular view part of the growing role of OPEC Plus as kind of this looser, but still committed political alliance. And I think to your question about Russia, one of the weird things about Russia, and again, depending on which analyst you talk to, there's coming out of this meeting, and again, this 2.2 million barrel a day cut meeting, everyone's watching it, right? It's been delayed. Everyone's glued to the screen trying to figure out what the heck is happening. And as soon as the meeting concludes, it's like, okay, meeting's done. I was chatting with like a bunch of different analysts and we're all like, which numbers are you using? Like the whole thing is just, it's clear as mud now. And as an example, so Russia had these unilateral 300,000 barrel a day export cuts. And the export cut here bit is important because that Russia is the only country that denotes its commitments in terms of exports, because it argues it has very seasonal effects with exports and da-da-da-da. But like my general point is, and I think a lot of analysts just ignore these cuts entirely, and I don't think wrongly, because unless they are committing to increasing domestic demand or increasing domestic storage or something weird like that, it has to be a production cut. Like the exports need to come from somewhere. And if you're producing it, where else is it going? So I think that whole issue is itself, I think we've seen lots of examples historically of, gaslighting from Moscow, and a specialty in terms of the type of information warfare they engage with is they just say a bunch of nonsense, a lot. And it's almost impossible to invalidate because like it's all wishy-washy and weasel words and like shifting goalposts and everything else. Like Russia's cuts have shifted multiple times. Its baseline has shifted multiple times. Like versus anyone else in the alliance, it's nearly impossible to really exactly track what Russia is promising and if it's actually complied. This latest export cut is denoted partially in crude and partially in refined products. Again, it just makes no sense. And I think part of that is the purpose. And I think for both Russia and even Saudi Arabia, they're like, well, sure, we'll pretend that Russia is complying and that it's being a good team player. Because again, it's more meaningful for Russia to be inside the tent and misbehaving than outside the tent. And I think that, for me, I think speaks volumes to the entire disposition of the organization right now.
We did an episode with Peter Pomerantsev a few years ago that dealt in part with the messaging that comes out of Russia. And listeners know that I had a television program that I produced on RT. So I have been inside the messaging engine, and I can tell you that this is by design. It's a universal thing. It isn't just in this area. There's a general sense of creating obscurity in messaging so that it's hard to explain. I would tell people, go back to listen to that episode with Pomerantsev. So I want to talk about geopolitics, both the Guyana Venezuelan territorial dispute, because I think, one, that also touches on something that we've talked about on the show for years, which is that as the world goes from a unipolar to a multipolar world, you're going to see old conflicts like that begin to get exacerbated and renew because there's no cop on the beat. The U.S. isn't there to set the rules or enforce the rules. And so you're going to see things like that happen. And I think this is an example of that. It touches on that. There's also a question of how realistic are these concerns, or how much is it just Maduro just trying to hype up, political excitement. And then Iran, Israel, because we have this thing that's ongoing again. This people that listen to the show know the Iranian connection to the Israeli-Hamas conflict, and now potentially to anything that happens with Hezbollah in the north, and a possible escalation in the Strait of Hormuz. So those two things I want to ask you about, Rory. But before I ask you about those, just to close off this Russia thing, what is up with the ban/cap? Is that now universally seen as having been a failure? Like, should we even talk about it anymore? Like, what's the status of that?
Yeah, I wouldn't say universally a failure, but pretty close to universal, like near universally considered a failure. I think there have been a lot of missteps. And I think, if listeners recall, like I was actually like a reasonable defender of the price cap, at least on theoretical grounds when it was initially announced. But, I talked about a lot of the ways that Russia could get around it. And essentially they did all that and more. I think a lot of the errors were compounding. I mean, like initially, like there was no reason to have a price cap while also maintaining blanket export bans on Russian petroleum into Europe and the United States. Like if you're trying to monitor the supply chains and the flow of this oil, you should probably be using your geographic advantage there, your proximity to Russia, because then you'll have a better sense of those prices in those supply chains by saying, no, you can't sell above this price and you're not going to sell to us at all. You're pushing an already hard to monitor commercial relationship that much further out of your effective view. So I think that was fundamentally one of the issues. And from people on the inside that I'd spoken to, apparently the main reason that both were done together is that by the time the price cap was finally decided and finally agreed, I don't know if people remember, but it took ages to kind of get the details worked out. By the time that was done, the EU sanctions had already been buttoned up, and that to unbutton them to kind of adjust things would have just been so much of a political headache. No one wanted to do it. So I think part of it was unfortunately like dead in many ways from the get-go. But I think the other challenge here is that one of the things people talked about was this potential emergence of, a shadow alternative system. And what we've seen is a massive historic rise in the size and scale of this so-called shadow fleet of these old, should be retired rust buckets that are now transporting huge volumes of crude around the world, which is itself a disaster in the making because these ships are unmonitored. They do not have the same robustness, say at the very minimum, of insurance. They are themselves rust buckets that should probably be retired, and rust buckets that should be retired are more likely to break down and, let's say, explode or leak or anything else. And you have seen multiple examples over the past year of shadow tankers from Iran, from Russia, and from Venezuela all running into various environmental issues or whatever else. So I think it's only a matter of time. The longer this goes on, the higher the risk is that we see like a true disaster, which I think is a deeply unintended consequence of the price regime. And you also have shadow insurance. And I thought that the insurance side wouldn't be as much of an impediment as people thought, because again, if we're talking about Russia being the exporter, well, Moscow can just set up a state insurance company, which is exactly what it did. You can talk about, China. Well, Beijing can just insure it. The buyers can insure it through state-backed insurance in China, all outside the normal kind of Western, kind of Lloyd's kind of entangled system. And again, that was fine. But I think the extent and scale of the shadow fleet buildout was surprising. But I do think generally, like there was a lot made about the fact that we're now back below, the $60 cap for Urals. And that's mostly just because we've shed $25 off of the price. It has nothing to do with tighter enforcement. Although the final thing I will say here is we have seen the beginnings, like U.S. Treasury is starting to enforce a few more actions against violations of the price cap and various other things. So I think it's still an open file, but I think at this stage, again, I was one of the more supportive analysts at the beginning. At this stage, I just don't care anymore. Like, yeah, it's fine. Like, it's not something I actively think about anymore.
That's interesting. about the environmental factor, that's not something I'd considered or heard anywhere. Is that something that people are talking about? The risk that one of these tankers could sink and then we have an environmental catastrophe? Because, by the way, that would be a disaster for Joe Biden. That would be a huge disaster because he's already getting heat from environmentalists for backtracking on some of the stronger rhetoric around climate change and curbing emissions, et cetera. If there was some kind of environmental disaster, like an Exxon Valdez, that would be really bad for U.S. domestic politics. Is that an angle that people are talking about?
Yeah, I mean, I think it would be reasonably easy for the Biden admin to just kind of say, like, this is Russia's fault because Russia is bad and, and they're getting around the law in order to do this. I mean,
I'm not saying that Americans would blame.
It opens them for sure. It opens them to criticism. Yeah, absolutely.
I'm not saying that U.S. voters would blame Biden for the sinking of a ship. But I think that what it would do is it'd be just like the Fukushima thing, right? After Fukushima, the Germans went super anti-nuclear. Yeah. And we've seen that with previous nuclear catastrophes. And I don't remember what happened. In fact, when I was a kid, I first learned about the Exxon Valdez from watching Waterworld. Remember that movie where they actually
I love Waterworld. A Costner classic.
Yeah, exactly. Way over budget. So for people that don't know that movie, it's a movie that I think probably the most over-budgeted film ever, like the biggest loss maker ever.
It's famous for how much they spent on it and how much they didn't make on it. But it's actually a really good movie.
It is. It is actually a very good movie. And it came out shortly before Titanic, whereas Titanic relied on CGI. They actually sank stuff in Waterworld. They went full analog, so definitely worth seeing just for that. So geopolitical risks, Guyana, Venezuela, you've talked to us before about what's going on offshore in Guyana and really how big of a deal that story has been. You can quickly summarize that if you want. And then what's the reality around this territorial dispute and how serious is it and what impact could it have on the market?
Yeah, so I mean, the main thing people need to know about Guyana is that 5 years ago, Guyana was producing no oil. And now it is rapidly growing into what will be likely the highest per capita producer on the planet. It'll be like Qatar, but Latin American and oil instead of gas. Guyana is a very tiny country with a tiny population.
What are they doing with all that money? Are they going to give like a dividend the way the Norwegians do? Like, what's the deal?
Well, there definitely are plans for kind of a sovereign wealth fund along kind of a very kind of, normal path. But I mean, again, Guyana was also one of the poorest countries in Latin America, if not the poorest country in Latin America. I can't remember what the exact number was, but huge development impulse there. The hope is that, again, that you don't get another classic replaying of the oil curse. But like, there's gonna be a bunch of other benefits. Like right now, Guyana, most of its electricity is produced by burning petroleum, fuel oil and diesel. A lot of the associated gas production that's coming from the oil production offshore is actually going to get piped back to the mainland in order to be used in domestic natural gas production and natural gas fired generation. So, I mean, this is like nothing Guyana has ever seen before. Massive, massive windfall for the Guyanese, obviously. But now, obviously, and I mean, when I wrote my piece about Guyana last year, I noted that there is this like lingering territorial dispute with Venezuela. And for the full historic context here, this was initially a dispute that was done between Caracas and the British back when Guyana was a British territory. I think that the actual date of the treaty was like 1899. And Venezuelans have been pissed about it ever since, basically. They feel like they gave up this huge chunk of land. It's about 2/3 of the total land area of Guyana.
It's the size of Greece, I've read.
Yeah, it's massive. It's not just the land. It also covers basically virtually all of the offshore area that, including the Strohbrook block, that Exxon and Hess and CNOOC have basically obviously had so much success. The first thing I'll say is I do not expect it to be a major issue. I think most likely the reason that Maduro, and basically what happened was a couple weekends ago, I think 2 weekends ago now on Sunday, Venezuela held a referendum on basically whether or not they should take this territory back and create a new state in Venezuela. And the referendum was 95% in support of this decision. Now, turnout was low, et cetera, et cetera. But obviously, Caracas can say, look, resounding success. I will do what the people want. They have already created subsidiaries from PDVSA and the nationally owned gold company in order to create leases and stuff here. They're going through all the motions. But importantly, I think the the major impulse for this. And obviously, this has been a lingering century-old dispute, got supercharged after all the oil discoveries again, but again, was still mostly on the back burner. The reason I think it's happening right now, more than anything else, is the fact that Venezuela has a presidential election next year. This is more about domestic politics than it is about geopolitics. And I think the factor that's really driving it is, again, reclaiming this territory remains very popular domestically in Venezuela. And by coming out so fervently pro this side, Maduro is kind of almost forcing the opposition to take the other side of this, which for them would be taking the other side of a broadly popular political movement. So I think that is really the main question here. That said, obviously, there are supply risks. And I think there are supply risks on both sides of this dispute. Obviously, there would be a huge risk of Venezuela if the Venezuelan Navy actually decided to just go start attacking, floating production vessels off Guyanese waters. But there's also risks to the Venezuelan side because a couple months ago, the Biden administration lifted a bunch of sanctions on Venezuela's oil industry as part of an incentive package to get them to agree to a bunch of concessions regarding that election for next year. Now, they've been slow, dragging their feet, doing the bare minimum. There has been some progress. But again, I don't think the Biden administration was thinking in the middle of these negotiations that then they would go hold a referendum to annex most of its neighbor. I don't think that was on the bingo card. And I think the other thing here is that one more thing kind of lessening the likelihood that this really turns hot is I think Georgetown, the capital of Guyana, I think was very strategic in who it chose for its partners on its now very prolific Strobic block. We're talking Exxon, the preeminent kind of largest US kind of national champion major IOC, Hess, which is another kind of large US company, and then CNOOC, one of China's state champions. So I think, they bought a little bit of geopolitical insurance there by the partners with which they partnered. And I think that will help them further hold off. And you've already seen the US has come out fervently in support of, Guyanese, territorial integrity, all the normal language. But there's even talk about military exercises and stuff. And again, I think never say never in the oil market. Who knows how desperate Maduro will get. But again, it's not like Venezuela's oil industry needs the oil, reserves. Guyana, while the fastest growing producer, its reserves are still a tiny fraction of Venezuela's, which on paper at least remain the largest on the planet. So if they really want to produce oil, there are ways that Venezuela can produce more oil without invading neighbors.
So another conflict that I mentioned was Israel's ongoing war in Gaza, but the sort of proxy war with Iran. And the fact that this hasn't concluded yet, we still don't know where and how this is going to get resolved. It's a very complicated problem. And there's a risk that seems to not really be apparently priced into the market that it could escalate. Do you agree with that sort of characterization? And what are the risks there that something could get out of control at the Strait of Hormuz, that we could have some kind of blockade, et cetera?
I think it's still a tail risk. I think at the end of the day, I don't see it likely that the whole Iranian situation explodes. I think, again, if you're looking at where the vast majority of oil is going, it's going to China. The vast majority of Venezuela's current exports are going to China. The vast majority of the bulk of the oil coming out of the Strait of Hormuz is going to China. I think Beijing would be very, very displeased with its now effective client state if Tehran turned around and blockaded the Strait of Hormuz. It would be worst of all for China. So I think is number one of the factors I think that would prevent Iran from kind of going insane in the Strait. But obviously, again, never say never. I think, this is obviously an extremely volatile region, an extremely volatile political discourse around Israel, Hamas, and kind of the Palestinian territories. Anything can happen. But I still think from a kind of the way I'm assessing the market, I think if anything, we're probably seeing a bit of a plateauing of what China has been willing to take from Iran. And you're starting to see a slowing of production gains in Iran, which had been growing gangbusters for most of this year, up something like, depending on the numbers, like 600,000-700,000 barrels year on year, which is a big number. I mean, second only really to the United States. But I think, again, they have another, call it 500,000 barrels a day that they could add to the market, maybe 700,000 barrels a day to add to the market. The upside of their production capacity estimates, their latest. But I think more likely they're going to tread water here for a little while. But again, that's one of the areas that you could see. I mean, again, it could be a further bearish weight on the market next year if Iran does indeed find a way to pump and export more crude again.
So, Rory, besides investor positioning, which could lead to a move upwards in the next, I guess, several weeks or month, what else is foreseeable for you? What are you looking for? And I know you don't do prices, so express it however you want. Like, what do you see going forward for the oil market until our next call?
Yeah. So I think, looking into next year, I am about as uncertain as OPEC is, really. I think anyone that has a very, very firmly held position right now, I think should check that confidence. We talked at the very beginning about the overconfidence in the market, which will never go away because oil loves to attract that type of person. It's one of the beauties of commodities, a whole bunch of colorful stripes. But when you're looking at next year, a lot of moving pieces, I think, are still kind of unknown. Will U.S. supply growth really more than halve? Or will we see, once again, a huge upside surprise that will force OPEC on its back foot again to cut more? Will we see demand growth continue at this currently very, very healthy clip? I think this year's been strong for China, weak for a lot of the rest of the world. Do we see a bit of a reversal of that? Do we see the rest of the world begin to reaccelerate again? Maybe China kind of take a breather because the growth has been pretty staggering. But the challenge with demand is, and I've said this, I think, to you a bunch of times, that like prior to COVID, on demand, it was hard to firmly estimate demand exactly, but you had really, because it's just so dispersed, but you had really good, like long-lasting trends in the oil market around, let's say, how many more people were flying every year and where the efficiency gains in jet travel were, and et cetera, et cetera, et cetera. It's hard to know, though, whether or not any of those trends have reemerged. Are we going to get a bounce back to those previous growth levels? Do we have more catch up to go to reach those previous highs? Like, people are making big deals about this year, like we're back at all-time high, jet travel. But we're not yet back at all-time high jet fuel consumption because we've had efficiency gains over that period. It's hard to know whether or not we're actually going to get the same pace of air travel growth that we were expecting pre-pandemic, for the very obvious reason that, like, you and I have been, our entire kind of relationship to date has been through Zoom. Whereas historically, I don't think that would have been the case prior to COVID. It just wasn't that normalized. People would fly places for like taping and podcasting and everything else. I think that alone has changed so dramatically that I don't know whether or not we can be as sure of that. And obviously there's, renewed kind of enthusiasm coming out of these latest COP negotiations to double down there. All I'm saying is that, demand next year, I think bulls will be hoping for kind of 1.5 million barrels a day of growth again or plus. But, that alone, let's say the US grows by 700,000 barrels a day of supply and Guyana adds another 200, and let's say Brazil adds another 200. Well, pretty close where, the OPEC doesn't have a huge amount of room in there to not cut further, let alone kind of return that production to the market. Canada as well is actually supposed to have a really good year next year because growth is continuing to go ahead. We're getting a major pipeline up, and you've had a lot of depressive base effects this year between wildfires and heavy maintenance, et cetera. So a lot of areas of non-OPEC supply could see continued growth again next year. And I think at this stage, my bias is that OPEC will hold the line and kind of prevent a very kind of like a serious precipitous collapse. But beyond that, I don't see a huge amount of kind of violent upside potential because you just have such a huge spare capacity cushion now with OPEC.
So I want to remind everyone again that if you have any questions for Rory, he's part of our community, so you can DM him in the community platform or tag him in the video comment section if you have any questions that you wanted to ask him today on the call but didn't have a chance to. Same goes with getting access to his research. Just send him a DM in Circle and you guys can take it from there. Rory, thanks so much for coming to speak to our community again today, man. It was great.
Thanks for having me, Demetri, and thanks everyone for joining.